Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And before we get into today's Q&A episode, I just wanted to take a moment to thank you for your tremendous feedback. I happened to go to a couple of wine events over the last couple of days. I've spoken on this podcast before. It's one of my passions, wine. And I ran into a few people that listened to the podcast, and they were generous enough to sort of come over and introduce themselves and express their gratitude for, what they've learnt. And it means a lot to me. It's good to be, in a environment where you don't necessarily expect it. It's lovely to receive that feedback. So I'm really pleased that, a lot of people get a lot of value from it, and it really energizes me to think about how can I take it to the next level. The best thing you can do, however, is not only, thank me, that's great. I appreciate it. But, pass on the information. The more the merrier, the more the people that it can help, the better off it is. One of the guys that I listen to or read his blog every day is Seth Godin. And, he talks about how ideas are scalable, that if you share an idea, it doesn't diminish its value. So, whether I write a blog and 2 people read it or 200,000 people read it, it can still generate the most amount of wealth. So it's really scalable. Anyway, I just wanted to call it out because, not everyone, I think, gets an opportunity to get feedback from their work, and I appreciate it. Okay, so let's get into probably a perfect starting question from Dave. So Dave writes, like everyone else that emails questions, I'd like to start by thanking you for your fantastic, honest and thoughtful service. I've learned so much from you and look forward to continuing to learn more. I was very interested to see a recent Grattan Institute research on Australian household wealth. It shows that only 5% of households have more than $1.3 million in super, and only 1% have more than $3.2 million in super. You've said that you value the opportunity through your podcast to reach a broader audience and presumably less wealthy audience. But you've also said at times you consider yourself the barefoot investor for people with money. I've said that, I agree. I wonder how accessible you think your advice is for the average listener. For example, in one of your blogs, you suggest aiming for $120,000 of expenditure in retirement would require $2.75 million in super. But the Grattan data above suggests that less than 5% households are currently doing this. Similarly, the Choice website says that Australians on a high income retiree couples only spend $90,000 a year in retirement, requiring a $1.1 million nest egg. I hope I'm not coming across critical here. I'm genuinely curious what segment of the population you see yourself speaking to, and thought these examples might trigger some interesting reflection. Thanks again. Keep up the amazing work. So, Dave, it's a really good question, and I appreciate it. I certainly don't take it negatively. I would say the podcast is really aimed at the wealthiest 20% of Australians, which would hold most of household wealth in Australia. So I'm not surprised by those figures from the Grattan Institute. And wealth inequality is not only rife in Australia, but I think it really in Western developed countries. And there's really nothing that can be done about it. Well, there's things that could be done, of course, but they're never going to be done. So you're not going to change it. And wealth inequality is just going to get worse and worse and worse. Now, I acknowledge that the other 80%, so excluding that top 20% in terms of wealthy individuals, need help too. But I think that market, there's a lot of information out there in that market. And, it's also difficult to teach people about money if they're not willing to learn, or if, their experience or story with money is so ingrained that they're just not going to tune in. So you could have a podcast that's going to tell people how to get out of debt, all those sorts of things, which is incredibly valuable. But the people that you probably really need to help maybe won't listen to that podcast. I'm not saying that's not work worth doing, and maybe I'll do something like that in the future. But really what I'm more in tune with is to really help people that do have money to invest and just make sure they make really smart decisions. See, the thing is that really when I started my career, and I started in chartered accounting, so I was a chartered accountant, worked for KPMG and Deloitte. And back then I would hear stories, and this is really sort of early 2000s, late 1990s, that long ago. And the financial planning industry was a lot different than it is today. It was really commission based. There was no such thing as good advice almost. It was just really sell product. And that product was laden with fees because, of course, it had to pay commissions and people were worse off. And I used to hear these stories about how other people in financial services, even though I was in chartered accounting, were getting ripped off. And that would really annoy me. And that's what sort of driven me over the last 25 years is to help people with information and money to invest, not to get ripped off. And there's still plenty of people out there that are just focused on their own pocket. And if they can sell them, a new build property and get a $30,000 commission and move on and not care whether it works out for that person, there's still plenty of people out there like that. And that's what I want to help people with. Because I guess the top 20% have more to gain and more to lose. And so the value or the outcome of their decision making can make a big difference to not only them, but their families and maybe future generations as well. So, look, it's not curing cancer. It's not massively altruistic. It's not altruistic at all, really. But that's really the segment that I enjoy because I guess that's my main aim is help people make great decisions. And they could make bad decisions because they're dealing with someone that's going to rip them off, or they could make bad decisions just because, they just don't have the necessary knowledge and particularly experience to make good decisions. And so that's what I'm really aiming for. So I 100% realize that in terms of Australia's population, that I'm really aiming at I say 20% because, I could be talking to someone that's just started their career and they're going to buy their first home and they're not going to be, probably not even going to be in the top 20%. But I guess, people that have the opportunity and the privilege, I would say, to be in a situation where they're going to have money to invest. And if they do that really well and wisely and avoid making massive mistakes, they can put themselves in a great financial position. Whereas Barefoot Investor, if you think about it, really speaks to kind of the other 80%, talks about, managing bad debt, credit card debt, cash flow, investing super well, all those sorts of things. And that's very important work. But I feel like that space is, and his book, Barefoot Investor, has done tremendous work. It's sold millions of copies. That market is kind of full, if you like. There's a voice in that market. I want to be a voice in the other market. But thanks for the question, Dave. It's really interesting to kind of reflect on it, and I have reflected on it a number of times. The thing is that not everyone in that top 20% will either maybe need a financial advisor maybe in their lifetime, or at least now, maybe for the next period of time. And so the podcast allows me to speak to a wider audience that won't necessarily be clients, and that's what I enjoy also. Okay, so next question is from Stefan. Stefan writes, I want to thank you for kickstarting my financial literacy. I'm a huge fan of your evidence-based approach. For context, I'm 36 years old, earning $125,000 a year and aiming to work part-time from age 55 onwards so I can keep my investments untouched until then. Two questions. First question is, given the US's broad selection of ETFs, particularly those with factor tilts that historically generate excess return, for example, Pharma French, how much should Australian investors be concerned about the foreign exchange risk and tax drag and exchange costs? Since income is paid in Aussie dollars, does that effectively hedge exposure to the currency? So it's a good question, Stefan. Like the product suite, ETF product suite in the US is, obviously substantially deeper than what it is here in Australia. And you're right, you then have to then account for foreign exchange risks. And that's, that's going to be different at different times. So when, the Aussie dollar was trading at around 60 cents, I would say putting new capital into the US market, into a US-domiciled ETF is going to be more risky. Whereas if you go back to kind of around the GFC or just before it and the Aussie dollar was parity, well, then I would say, investing in US ETFs at that time, wasn't such a big deal because your downside risk in terms of the Aussie dollar continuing to appreciate was really low. And in fact, if you look back, it would have done really well. So I think it's a point in time moment from the foreign exchange risk, which means that the Aussie dollar is like 65 cents as I'm recording this today. Long-term average is 70 cents. So I would say that you've got a little bit of risk by investing in US-domiciled ETFs, which is to say I wouldn't do it. I wouldn't do it to a significant extent. So I wouldn't be putting a large portion of my portfolio. I have often thought about, wanting to access markets with certainly with certain factor ETFs. So, for example, an ESG investment in the UK would be good because a lot of my clients have concerns with investing in the FTSE 100 because there's British American tobaccos in the top 10. So that's a concern for some investors. Also, wouldn't mind a quality or value approach in that UK market as well, on the basis that the whole market looks relatively undervalued. But then let's pick the stocks that even in that context are undervalued even further. So I've thought about it and I've looked into it, but I've discounted it. The other problem with the US is tax and tax treatment. And you've got to prepare each year W-8 Ben forms, which are sort of tax forms, which are unnecessarily complex and just annoying. So it's not going to change your life necessarily, but it is annoying. And then also, particularly over the last sort of 10 years, it's not just Trump, but other governments as well. They've been really cracking down on foreign investors and foreigners having investments or money in the US. And that can make it really difficult too. And some tax consequences are quite punitive. And don't forget, we've got state taxes and federal taxes in the US. So we really need it. So it makes it unnecessarily complex, for which for that reason, I've decided not to do it. I think the ETF market in Australia is growing. It will continue to grow, and I think the product suites will become wider and wider. And I would much prefer to invest in a Australian domicile fund. I should say that going back 10 years ago, a lot of ETFs in Australia were actually US domicile. I can't even think of maybe one that still is US domicile, and it just really makes life a lot easier, particularly from that, I guess, tax legislative risk issue. So that's question number one. The second question that Stefan has asked about, he's asked about how does the Australian tax system treat Irish-domiciled accumulating ETFs? And he's used an acronym here, UCITS, and I have never come across this product before, but he mentions there's an iShares MSCI World Quality Factor Index ETF. So I guess that's what's attracted to him. And he said he's done some research and it suggests that we've got a double tax agreement with Ireland. That doesn't surprise me. And that if the distributions are reinvested, that he's not going to be taxed on that, and that's just going to compound. And then one day when he sells those investments, then he'll pay capital gains tax there. So none of that surprises me. Normally, how overseas investments are taxed, particularly if we have a double tax agreement, is that essentially you'll pay Australian tax. You might pay some overseas tax, but you'll always get a credit for that here in Australia if you've got a double tax agreement, typically speaking. And so when we look at investments that are held overseas, we can, from a taxation perspective, we typically just assume that we're going to pay Australian-based tax, which is obviously tax on any income that you receive, and then tax on any capital gains. So if the product reinvests income, so it doesn't actually distribute the income, then you'll avoid the tax and it will continue to compound. Again, this might sound attractive, to find products around the world that are going to do that. And it can be attractive, but the biggest risk is, just a change in legislation, a change in tax treatment. And again, the learning we can take is what's happened in the US over the last, as I said, 10 to 15 years. They've become quite punitive. And I guess that there's one thing that voters aren't going to worry too much about is the taxation of foreign investors. So that's an easy one for governments to change because it doesn't lose them any votes. And most people think, if you're Australian, someone's investing a lot of money in Australia, making a lot of money, we should clip the ticket and take some tax revenue. And that's what most people are going to think. So your legislative risk with respect to these sorts of investments is much higher, putting aside the foreign exchange risk. So I think given where the Aussie dollar is at the moment, I wouldn't be attracted to it from that perspective. If the Aussie dollar was trading at 80 cents or even above that, then I would think, okay, my foreign exchange risk is greatly reduced. Then I just think about the legislative risk and whether I want to also deal with the additional complexity. And I'm not really sure that I would. But great question, Stefan, because it's thought-provoking. It's something I've thought about before. To be honest, French Farmer you can access through Dimensional here in Australia. That you can do most of this sort of stuff through Dimensional. Vanguard used to have a multi-factor fund, which I loved. I thought it used quality, value, and momentum as the three factors, all in just one fund. Unfortunately, they wound it up. I don't know if they still run it in the US, but they wound it up here in Australia because it didn't attract too much money, probably too complex for the average investor to kind of work out. And that was a real shame. But for now, we're staying onshore with our investments. And I would imagine that the ETF market's just going to become more and more complex. And therefore, the products available will be deeper as well. And I don't feel like we are making too many sacrifices in regards to our portfolio construction. And the other thing too, I should add, in terms of an evidence-based approach, we don't want to be too active here. That's the thing. Like I talk about rules-based, evidence-based approaches. I've recorded a podcast about, all the index methodologies other than traditional market cap indexing. But the other thing we always must remind ourselves as investors, and something we keep reminding and talking about inside our business, is that we don't want to become active managers. And by that I mean that we don't want to start taking such an active approach with respect to these different geographical exposures and other index methodologies that our portfolio starts to look like something that doesn't even represent an index. Remember, indexing has worked really well, and we should start with the broad index. So if we look at the MSCI World Index, the broad sort of allocation across that index, that should be sort of our base case. And then we can tilt at the edges. And when I say tilt at the edges, we'd be underweight US, overweight UK, for example. I've spoken about that before. But we're not taking massive bets and saying all our international exposure is going to go into the UK. So that's one of the other things too, is I guess when we start to search for different style products, we just got to be really careful that we're not just becoming an active fund manager, because we know that evidence-based approach tells us that active managers, you can't pick where a market or index is going to go in the short term. And that's why you want to be, have tilts in your index rather than, take massive bets. Okay, next question is from Jed. Jed writes, noting the delta and interest charged on investment property and primary place of resident loans, and further, the interest rate delta on P&I versus interest-only repayments, is there a magic number for the gap between P&I and interest-only on investment properties that would dictate a switch over to P&I? So it's a great question, Jed. Just so people understand, of course, there's an interest rate differential between investment and home loan rates. And then, of course, for investors, there's also a difference between repaying principal and interest and repaying interest only. And that difference is about 0.15%. So 15 basis points, if you like. That gap has actually contracted. It used to be larger. It was over 0.25%. And at some point, maybe when it first came in, it was even higher than that. So it has contracted, which is kind of interesting, and maybe it will contract even further. The way I look about, well, actually, let's talk about the gap between investment and home loan. I think the Competition Commission, what's it called? The ACCC, Australian Competition Consumer Commission, should really look into why is there a margin still charged for investment loans, because, I would argue that there's no rationale behind it. I would say that, the profitability of those loans and the quality of them, so looking at arrears and write-offs and those sorts of things, would be different. But anyway, let's put that aside. As I said, the gap between interest only and P&I has contracted over time. Maybe that will continue to go. The way we tend to look at it is if our client has finished investing. So like if the strategy is to acquire 3 investment properties and our client now has 3 investment properties, then we will consider what else will we tell the client to do with cash flow. Quite often we would be directing surplus cash flow to a variety of areas. So maybe some additional super contributions, maybe we're doing some regular share investing, and the rest probably goes into offset, as notional debt reduction. If that's the case, in that scenario, we would consider switching to P&I just to reduce the interest rate. Just because, if we're going to make a contribution towards debt reduction anyway, well, we may as well save 15 points on the interest rate. But for anyone that is continuing to acquire assets and their goal is to continue to acquire more assets, then remaining on interest only typically is the best approach, just because it frees up cash flow. And if you're in the age and stage of life where you're still aggressively acquiring growth assets, then you should really be focused on doing that rather than debt reduction. The flip side to that argument, however, is that if you do pay principal and interest, you don't really repay a lot of principal in the first 5 years of that loan. So normally a P&I loan is over 30 years, sometimes 35 with some lenders, and even getting to 40. You're not really going to pay a lot of principal in that first 5 years. So the cash flow impact can't be overstated. And what someone could do then is, in order to get the lowest absolute rate, is go on P&I and then refinance and reset that loan term every, say, 3 to 5 years. And if you did that, you keep sort of pushing it back to 30 years, you're potentially going to have a loan that you could hold for a long period of time, and you're not going to be forced to repay a lot of principal. So I guess there's a way to kind of play that game, if you like, that minimizes cash flow and still minimizes interest rates. In my personal situation, I've got some P&I loans and I've got some on interest only. I'm not too concerned by it, right? Because if I'm paying 15 points more for an interest-only loan and I'm getting a tax deduction for that, then I'm only really paying 7 basis points more. It's not going to change my life. Like, it literally isn't going to change my life. And so I don't get too sort of drawn up in it. And I feel like if I have an interest-only loan and just put cash in offset account, that gives me a lot more flexibility in the long run. And also then if that gap continues to contract as it has done over the last 5 or so years, then the premium I'm paying on an after-tax basis, again, it's not really going to change my life, and it's not a big consideration. It's, I guess, the same sort of thing with lots of other things in your life as well. Focus on the things that really matter and that you can control. And if it's not a big deal, then I wouldn't put too much sort of emotional labor towards the decision. But that's our typical approach. So thanks very much for the question. Okay, next question is from Mark. Mark writes, like everyone else who writes in, I'm so grateful for your service. I'm a regular listener and have read your books too. Thanks so much for the amazing work. So you're very much welcome, Mark. So just a bit of a rundown on Mark's situation. Mark and his spouse are in early to mid 40s, 2 young children that will be both going to school next year in 2026. They've got a renovated home in Canberra worth 1.35 with no mortgage, which is a great position to be in, of course. Total super is 890,000. 540 for Mark and his partner 340, both with Australian Super in high growth. 200,000 ETFs, mostly in Mark's partner's name, and 200,000 in a high interest savings account, also in Mark's spouse's name or partner, whatever. Total income, total family income, 280,000, Mark 160, partner 120. Both PRYGs may increase in the future if they start to work more, particularly as kids go to school, but reluctant to be locked into long-term current pay levels. I'm not sure what that means. Anyway, they save about 6 to 7 grand a month and put into a high interest savings account and reinvest all dividends in the ETFs, ETF portfolio. They're not making concessional contributions, any additional concessional contributions above employer. Current annual expenditure is about 110 to 120,000. May drop a little, maybe by 10 grand when the kids go to school. And will likely receive an inheritance of between $500,000 in today's dollars in 10 to 15 years' time. In terms of their goals, they plan to upgrade their home in the next 1 to 2 years, either in Canberra or move to Brisbane. And they've been looking at the sort of 1.8, 1.9 mark, but wondering if that's too conservative. They would like the option to send the kids to private schools, either in 2028 or 2030. And the cost is going to be estimated to be $560,000 in today's dollars. They may not end up doing that, but they want to be able to afford to do that if they need to, and that's why they've been putting money in savings and ETF portfolio. Want to support the kids to buy their first home, comfortable standard living in retirement, $90,000 to $100,000 in today's dollars in terms of spending. And also have the option of semi-retiring in our late 50s. So the questions are: should we max out borrowing capacity on a new home based on the idea of live vesting, which I've done a blog about? If so, what sort of budget should we consider? Is 1.8, 1.9 too conservative? Should we buy an investment property? He says, I'm attracted to buying a unit in Melbourne. Especially if we buy in Brisbane, and we're buying at the top of the growth cycle. What should we do with our ETFs? Should we sell them? Do you think industry super in terms of Aussie super, where they're invested, is the right option? And should they think about making additional concessional contributions? So, Mark, there's a lot in there. So there's a huge amount in there, actually. Let's go in reverse order because the easy bits first. So concessional contributions, no, I wouldn't do it for two reasons. Your super balances are already pretty healthy for your age. Let's call it 900,000 in terms of total super in your family. So that should be worth 1.8 in 10 years and maybe about 3.5 in 20 years. So circa, getting close to sort of 60 or just after 60, I should say. That's going to be, a really good start in terms of funding retirement. That'll probably do it by itself, to be honest. So the goal with super is to try and get as much in as soon as possible and then benefit from that compounding growth. It's your returns and fees that you pay over the next 20 years that will have the biggest impact on your balance, not whether you make additional contributions. Of course, additional contributions will help, but they will be relatively immaterial relative to the compounding returns that you might receive. So I don't think it's a big deal. You already have really healthy balances. I think it's okay. Plus also, if you want to have the flexibility to partially retire in your 50s, putting more money into super today doesn't really help you in terms of achieving that goal. Let's talk about Canberra versus Brisbane because it's kind of an interesting one. I mean, if you look at Canberra property over a very long period of time, it's done pretty well. It's done really well in terms of median house price growth. So if you look at the evidence, you would say, Canberra is a good investable location. It struggled over the last couple of years, but it did have a really strong growth spurt through that COVID period. So it's in the cycle, I think, relatively attractive today. Whereas Brisbane's probably 7 years into a 10-year growth cycle. I say 10-year growth cycle, it could continue for longer than 10 years. But again, looking at the evidence, the mean and average growth cycle period is 10 years, almost bang on 10 years, both on those statistical measures. So that's what you could probably expect. But sentiment drives markets in the short term, and just the sentiment around the Olympics in Brisbane could mean that growth cycle lasts a little bit longer. So I don't know if you're buying at the top of the cycle. You could buy today, and it still grow, or buy in 1 to 2 years' time and it could still grow. And I suspect it probably will. Maybe not at the same rate as it has done over the last since 2018. Maybe not double digit, but maybe high single digit. But if it's home and you're making a really long-term decision, probably not that big a deal. And arguably, if you are going to buy into a market that's already done relatively well, then quality is more important, I think, in that market. Whereas if you're buying, in a market that's been through a flat cycle for a long time, in a rising ship, all ships rise. And quality becomes less important. I don't want to say those words in this podcast because I talk about the quality of the assets drive your returns. So I want everyone to buy a great quality asset, but I'm just saying, in terms of where you're buying in the cycle, quality starts to become more important. So if you were if you're buying in Brisbane or Canberra, I probably would try and stretch the budget in both of those markets, to sort of 2 or between 2 and 2.5, because I think you're going to get a better quality asset in both those markets. And I would have the same budget in both Canberra and Brisbane, I think. That's true in both those areas. I really put aside, I think, when I'm answering these questions, I think if money wasn't an object, if I didn't need to worry about money, what would I be spending in both those markets? And then I kind of relate it back to the current scenario and then work out, is that silly? So, if I spent 2.5, for instance, with costs and so forth, you're going to end up with 1.5, just rough numbers, 1.5 million of a home loan. That's probably, that's a lot. And maybe if you did that, it'd probably work out, but maybe your goal in terms of earlier retirement or earlier partial retirement might be jeopardized. So maybe sort of just 2 to 2.2 might be a little bit more comfortable in your scenario, but somewhere around that 2 mark then, I think. Ironically, if you did that, so if you're going to take on more debt, then we want to then think about how you're going to repay the debt before late 50s so that you can contemplate, early partial retirement. Actually, ironically, the response sometimes to that decision is to go and buy an investment property. So, for example, you could go and buy something in Brisbane or Canberra for 2.2, then go and buy a villa unit in Melbourne for about $1 million. And I say villa unit because I know I just spoke about apartments, and I think apartments do really well. You could go and buy a really great 2-bedroom apartment for $850, or a villa unit for $1 million. I'd probably still lean towards the villa unit, just because of the land value component. But both those investments, I think, are going to perform really well. So I'll probably go and buy something like that as well, with the idea of at least, you could then contemplate early retirement, even if you still had a little bit of non-tax deductible debt, still had a little bit of home loan debt, on the basis that, when I fully retire in a few years' time, I'll sell the investment property and that's what I'll use to get rid of all my debt. If I did that, then I would probably would get rid of the ETF portfolio and certainly use all the cash savings to try and extend my budget so I could do both of those two things. Which ironically, and I don't think I read it out, but Mark actually made a comment that he's really comfortable with investing in ETFs and doesn't really know much about property. And I've just realized that looking at his situation, I'm sort of saying go all in property. Not really, because you've got the super, of course, that's invested in the share market. So you've got a relatively even distribution. But anyway, it is what it is. I'm not going to give advice, just the advice that people are most comfortable with. sometimes the answer lies in being a little bit uncomfortable at times in terms of your approach. I'm not suggesting you should do something that if you're not comfortable, you've got to become comfortable with it. But maybe the initial sort of impression or approach of what you should do maybe isn't always correct. So I think if we did that, spend sort of 222 on a home, that way you're going to get yourself in a really good quality location. That means if it all turns bad, at least you've got a good asset to sell to reduce debt. Buy the investment property. Hopefully over the next 10 to 15 years, you can put a lot of cash flow towards repaying the family home. If that doesn't work, well, at least you've got an investment property to sell. If your super underperforms, well, at least you've got an investment property to sell. But the probability is that by the time you get to retirement, you'll have enough super to fund retirement. You've hopefully got rid of all your non-tax deductible debt, and then you've got the investment property there that you can use as a future early inheritance, help kids get into their first homes, whatever you might want to do, and or as a bit of a safety net to kind of fall back on. And in that analysis, of course, then I can overlay. I don't necessarily rely on it, but it's always kind of in the back of our mind. Mark said he's got a potential inheritance of somewhere between $500,000 and $1 million in the next 10 to 15 years. Well, that can go towards repaying the non-tax deductible home loan debt as well, if and when that inheritance arises. And you don't want to be, I guess, if that inheritance happened in 10 years' time, you don't want to look back and go, well, I should have spent another $200,000 or $300,000 on a property. I would have been much better off. That's the sort of stuff that you don't, that there's sort of reflections you want to try and avoid today, and that's why getting that budget right is really important. So yeah, that's the approach that I would take. I think in your situation, and the reason that I take that approach is you've got relatively healthy incomes, and your super is already kind of off to the races in terms of its investment. In terms of whether you should be an industry super fund, I'm not against it. Keep things relatively simple and straightforward. But Mark mentioned my end of financial year review on super, so that's going to come in the coming weeks. So certainly just make sure you have a look at that and decide whether to stay at Aussie Super or whether to go anywhere else with that. And the other questions were, what do you do with the ETFs? Well, I think if it's a case of being able to spend more on the family home and or get the investment property, I would sell the ETFs and get yourself in a position where you're able to do that. Okay, just really conscious I've gone way over time today, but thanks so much for your question, Mark, and all the other questions today. And until tomorrow, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.